Welcome to Objective 9 in Unit 4 of Accounting 3310. In this last objective in Unit 4, we're going to look at the disposal of fixed assets. Disposal of assets occurs both in the normal operating process of replacing capacity and in strategic changes of entering and exiting lines of business and locations. How do disposals of assets appear in financial statements? Our objective here is students will be able to complete the financial reporting to dispose of assets. The principle here is that there will be a gain or loss for the difference between the carrying value of the asset and the consideration received for it. The effect on the fundamental accounting equation is that we've got to decrease both the asset and the associated accumulated depreciation account and increase the assets that are received. Whatever the difference is between those two is going to be a gain or loss that shows up in operating income on the income statement. Company depreciation policy will determine depreciation taken in a partial year up to disposal date. Since depreciation is typically taken only immediately before creating financial statements, disposals that happen in the middle of the year may need that adjusting entry to record the depreciation on that asset for the current year that hasn't been recorded yet. Another feature that's important is that assets that have already been separated from service and are held for sale do not continue to depreciate. You may remember, but we classified these assets not as fixed assets, but as investments if they're not being used productively in our business. Here's an example of asset disposal. Let's say we acquired this asset on January 1st of 2001. It has a 5-year service life that is composed of 100,000 units is over its entire life what it would be able to produce. The residual value at the end when our business is done with it is $5,000. It's expected to be $5,000. The allocation base then is that acquisition cost of $25,000. It's had no enhancements or no impairments. The annual straight line depreciation would be 1 divided by the useful life, or 1 divided by 5, multiplied by the acquisition cost minus the residual value. This gives us a depreciation of $4,000. If the asset is sold in April 10th of 2003, which is in month 4 of year 3, for $14,000, then we're going to need to accrue some additional depreciation, assuming it hasn't been taken for 2003 yet, up to the time of disposal. The carrying value at the time of disposal is the acquisition cost minus the depreciation so far. 2 years of depreciation have been taken, and we have an additional 3 months of depreciation that need to be taken. So 3/12 of 4,000 is the additional depreciation that's being taken. So 25,000 minus 9,000 equals 16,000. That's the carrying value at the time of disposal, having added in that partial year depreciation. The difference between the consideration received and the carrying value at the time of the disposal is the amount of the gain or loss on disposal. Here the consideration received was less than the carrying value, so there's a $2,000 loss. To record this disposal, we'll record both the depreciation, that extra depreciation for 3 months is $1,000 multiplied, which is found by multiplying 3 months out of 12 times the 4,000 annual depreciation. And then we record the disposal by taking the asset off of our books and the accumulated depreciation, recording the increase in cash, and the difference between what's on our books is going to be that loss. We've already calculated it, but you can see here how our debit and credit construction makes it easy to figure. At the point that we've got recorded taking accumulated depreciation of $9,000 off of our books and recognizing the $14,000 we received, there's $23,000 of debits. The asset coming off of our books is $25,000, so we needed an additional $2,000 debit. Losses are debits, they're reductions in owner's equity. I hope that you can see the steps involved in disposing of an asset. First, catching up the depreciation until the time of separation, and then second, taking the asset and its accumulated depreciation off of our books, recognizing the consideration received, and recognizing whatever the difference is as a debit, a loss, or as a credit, a gain. Thank you.